Morning everyone, Alex here from LFIS. Thanks for joining me on another episode of our weekly macro overview. A lot of news to get through this week, so we'll jump straight into it. Firstly, looking at Europe, last week we mentioned the economic sanctions that have been placed on Russia's economy and the implications those sanctions have had across Russian financial markets. As a result, Russia's central bank officials have decided to implement a contractionary monetary policy where rates have been increased by 20%, double the previous rate, which has been done to slow the growth in the money supply and bring down inflation. However, over the course of the week, as fighting intensified in Ukraine, Russia's contractionary policy proved ineffective in increasing the value of the ruble. As of February 4th, the ruble nears all-time lows, trading at 121.78 per USD. Also, the rate hikes have done little to revive financial markets. Russia's biggest foreign bond, 7 billion in debt maturing in 2047, has lost over half of its value to reach 30 cents on the dollar. SIBA Bank, which we mentioned last week, plummeted more than 75%, and TCS Group, which owns Tinkoff, dropped as much as 80%. In the UK, high street sales are now greater than before the COVID-19 pandemic. This recovery has come despite the renewed COVID-19 restrictions over the winter period. Spending in the month of January in local authorities itself was on average 4% higher than in 2020. Much of the spending has shifted online. Commuting is reduced significantly and consumers have chosen to shop near homes. Spending was more than 10% above pre-pandemic levels in several urban areas such as Hamilton, Blackpool, Sunderland, Shrewsbury and Barnsley. But despite the increase in sales, London still faces problems and serious questions over the future of its business model. Sales across the capital are still 10 percentage points below pre-pandemic levels. In the US Federal Reserve's intentions to raise interest rates has been reinforced by the much higher than expected US jobs data. According to headline NFP, the US economy added 678,000 new jobs in February, much exceeding the market predictions of 400,000. This follows a continued trend of higher than expected monthly NFP readings. In January, the US economy added 481,000 jobs compared to an expected 467,000. Furthermore, the unemployment rate fell for another consecutive month to 3.8% in February, down from 4% in January. Fed Chair Jerome Powell told Congress this week that the combination of employment gains and increasing inflation supported his case for a quarter point interest rate increase as the first step in a series of rises this year. However, Luke Ellis, chief executive of Man Group, a hedge fund based in the US, is skeptical about whether markets have truly seen the end of easy money, highlighting that the conflict in Ukraine could delay US rate hikes. Also in the US, the United States and other major energy consumers have agreed to draw down 60 million barrels of oil from emergency stocks to address concerns about dwindling supplies following Russia's invasion of Ukraine, a concern heightened by an enormous increase in crude prices on Tuesday. Since the start of the invasion, oil prices have surged and the WTI crude oil has gained more than 25%, ending this week at $115.68 per barrel. However, rather than calming prices, the announcement sparked an even further gain, with Brent crude, the international oil benchmark, soaring to decade highs by the end of the week. Finally, in Asia, China targets that in 2022 there would be GDP growth of around 5.5%, with last year's growth being 8.1%, and a budget deficit of around 2.8% of GDP. This is due to uncertain global recovery and a downturn in its property sector triggered by a government campaign to control borrowing among highly indebted developers. This led to a liquidity tightening which squeezed the sector and chilled buyer sentiment. As economic conditions soften, the central bank has started cutting interest rates and local governments have expedited infrastructure spending, and the finance ministry has pledged more tax cuts. The People's Bank of China will target a 3% consumer price index for 2022. China had made a vow to ensure key agricultural products, including grains, but according to the agricultural minister, the current wheat crop growing conditions could be the worst in history. And finally, on Friday, Sri Lanka's central bank sharply raised interest rates to help control inflationary pressures. The Central Bank of Sri Lanka raised the standing deposit facility rate and the standing lending facility rate by 100 basis points each to 6.5% and 7.5% respectively. Ajith Cabral, the governor of the Central Bank of Sri Lanka, said that in his post-policy news conference how they enjoyed single-digit inflation throughout the 2010s, and the goal is now to ensure price stability. In a note to clients, Capital Economics predicted that there would inevitably be more rate hikes in the coming months, penciling in another 200 basis points of tightening by the end of the year. The government was also urged to consider measures such as curbing non-essential imports and rising fuel prices to reduce pressures on the weakening economy. With the central bank's foreign exchange reserves dwindling, Sri Lanka has been unable to pay enough for its fuel to fire its power plants and has resorted to implementing rolling power cuts. And there we have it for this week, a short one, but thank you for watching nonetheless. So the question of the week is, questions loom over the necessity of the Federal Reserve raising rates this month, with conflicting indicators such as threats to recovery posed by Russia-Ukraine conflict and positive US jobs growth data. Do you think the Federal Reserve should raise rates sooner or later, and why? Do leave a comment and open some dialogue, and I'll see you next week. Thank you for watching.